Welcome back to our YouTube channel. Today we are going to talk about inflation in general and assess its impact on stock markets in India. So let's start with what is inflation. Inflation measures the rate at which the purchasing power of money erodes over time. Money acts as a unit of account, a medium of exchange, and a store of value. As a store of value, money's purchasing power is entirely dependent on price levels. As prices inflate, each unit of money becomes increasingly less valuable. In the simplest terms, inflation is the increase in the prices of goods and services which devalues the purchasing power of money and currency. When the inflation rate increases, the cost of living increases too, which leads to lower purchasing power. For example, if mangoes were sold at rupees 100 per kilo in 2010, then in an inflating economy, they would cost more today. Let's say that mangoes sell at rupees 200 per kilo in 2022. Therefore, in 2010, you could buy 10 kg mangoes for rupees 1000. But in 2022, your purchasing power will drop and you would be able to buy only 5 kg of mangoes of the same amount. To take our understanding of inflation a little further, let's look at what causes inflation. There are two types of inflation: demand pull inflation and cost pull inflation. Now, demand pull inflation occurs when there is an increase in supply of money. Hence, now the average income of people in an economy increases and they want to buy more products and services. It stimulates obviously more demand for a lot of goods and services in the economy, and that will make the inflation go up automatically, as during such times the demand can increase above the supply of the said product or service. Hence, there is a scarcity of goods and services that causes buyers to pay more for them. This eventually results in a general increase in prices. The second thing is cost push inflation, which basically means the increase of prices, but the prices increase in the production process of a particular company. The cost of that particular product will fall on consumers, and then we have to pay extra for particular product. And that is not because of demand. It's not because a lot of people want that particular demand, but it's because the cost of production of goods increases due to an increase in the cost of raw materials, manpower, taxes, etc. While this leads to an increase in the cost of production, it also causes a drop in the supply of said goods. With the demand remaining the same, the price level tend to increase, leading to increased inflation rate. Now let's look at something known as inflation and the Indian stock markets. The price of a share in the stock markets is determined by its demand and supply that is affected by a range of factors like social, political, economic, cultural, etc. Anything that affects the investor can have an impact on the demand and supply of stocks, and inflation is no different. Now let's have a look at how inflation impacts the stock market. Inflation directly affects the purchasing power of investors. Since inflation is an indicator of decreasing value of money, so if the inflation rate is 5%, then rupees 10,000 today will be worth 9,500 after 1 year. If the inflation rate increases to 10%, then the same amount will be worth less in the future. Hence, the purchasing power of investors decreases as the inflation rate increases. This can have a direct impact on stock market, since investor would be able to purchase fewer stocks for the same amount. Inflation also affects the interest rates. When inflation rate increases, the Reserve Bank of India increases the interest rate for deposits and loans. The idea is to incentivize people to save money and curb excessive liquidity, bringing the inflation rate down. Retail inflation has surged to 7.79% in April 2022, which preempted the unscheduled repo rate hike of 40 basis points by the RBI recently. When the inflation rates rise, it's harder for companies to borrow and more costly to manage what debt they already have, which impacts their ability to grow. It could also have an impact on companies' cost to doing business, thus changing how investors may value a company. Hence, the projected cash flows are valued lower, resulting in lower equity valuations. Moreover, interest rates are crucial when it comes to how the market reacts to it. Because if the interest rates are not attractive, if fixed deposit or debt instruments are not attractive, then all the people want to invest in stock market to get better returns. But tomorrow, if suddenly the interest rate becomes very attractive, then all would remove all the money from the stock market and start investing in a safe, risk-free rate of return from these fixed deposits and maybe 8% or 9% if it ever goes up, if RBI ever pushes it up. But if RBI keeps it low, then everyone starts investing in the stock market. If the interest rate go up, the safety net for fixed deposit go up, then a lot of people will remove their money from the stock market. And if they remove the money from the stock market will fall. Now let's see how global inflation and the stock market have something in common and why Fed changing the interest rates affects it all. But before that, let's first understand how printing of money works and why it affects inflation. Now, if you look at all the top countries in the world or top economies in the world, they have resorted to this thing known as monetary easing or printing of money since the last financial crisis of 2008. And now, what happens when more money comes into the hand of people? The demand for a lot of goods will go up, and suddenly everyone has a lot of money to spend. Demand will go up constantly, and if the demand goes up, it creates a demand inflation risk. Now, if inflation in these countries go up too much, interest rate might go up as well. Now, why US comes into the picture or why Fed is so important? If there is an inflation in US which is growing fast, then the US Fed has no other option but to increase the rate. Now you must think that this is the issue of US, so how does it affect us? Now what happens is that a lot of foreign investors who are investing in different other countries, all these foreign institutional investors are big people with a lot of money. They might just say, that why am I risking so much and investing in another country for 10% return when maybe US has just given me a risk-free rate of return of 8% or something like that. So whenever there's a risk-free asset or whenever it is safe, a lot of people might remove their money from stock market. So if FIs decide to exit and say US is better for me, then the selling pressure can drive the stock prices completely down. So this is something that happens, and if they remove the money, then a lot of Indian investors will start panicking. A lot of local DIIs and the retail investors will start panicking, which will push the prices down even more. Now this is how putting more money into the system makes inflation come into the picture and increases the interest rates, and then it might directly affect the stock market. When interest rates are high, things are heavier and the market slows down a bit. When interest rates are low, the market is lighter and tends to speed up with faster growth. As the inflation rate rises, speculation about the future prices of goods and services leads to a market environment that is highly volatile. Since prices are rising, many investors will speculate that companies will experience a drop in the profitability. Hence, some investors might decide to sell the shares, leading to a drop in its market price. At the same time, investors optimistic about the company making profits in the future might buy these stocks, causing a volatile environment. Value stocks are strongly impacted by a change in the rate of inflation and are preferred by investors when inflation is high. Value stocks are shares that have high intrinsic value than their current trading price. They are shares of mature, well-established companies with strong current fresh cash flows that may diminish over time. The market price of value stocks is usually directly proportional to the rate of inflation. Therefore, when the inflation rate rises, value stocks tend to perform better. On the other hand, growth stocks have minimal cash flows. Therefore, they have a negative correlation with the rate of inflation. The market price of these stocks drops when the inflation rate rises. Lastly, if we talk about dividend-paying stocks, then an increase in the rate of inflation can cause a drop in the market price. This is because with rising inflation rates, dividends can fall to beat inflation, making such stocks less attractive to investors. However, we must not forget a positive aspect of rising inflation. In fact, a controlled rise in inflation rates is a sign of growing economy. Normally, rising inflation is synonymous with improved growth in GDP. In fact, if you look at the world growth and even at India's growth rate in the last 20 years, GDP has never grown substantially when the inflation was low. While obscenely high inflation can play havoc with purchasing power, certain threshold inflation is required to incentivize producers and businesses. So, inflation beyond an acceptable limit is the real problem. Rising inflation has certain downside risk, but it is also essential for growth. It is this balance that holds the macroeconomic key. Therefore, investors must compare inflation rates in the recent years to assess if the increase is sudden or sustained. If the inflation rates are rising steadily, then it can be healthy for businesses and the economy and be a good environment for stocks. Long-term investors must also consider the fact that the government constantly takes measures to keep inflation in balance. And so, during rising inflation times, investors must avoid panic and emotion-based decisions and look for fundamentally strong stocks that can weather any economic storms with ease. So that's all for today. We hope that you liked our video. Do not forget to like and share this video. Thank you.